The next type of reorganization we're going to discuss is a Type B reorganization. In a Type B, the target corporation stock is exchanged for the voting stock of the acquiring corporation, and the target corporation remains in existence as a subsidiary of the acquiring corporation. The basis of the target corporation's assets and the amount of its tax attributes remain unchanged because it does not liquidate. After the reorganization, the parent and target can file a consolidated tax return. This is a transaction solely for voting stock. Usually no other property can be used as consideration. The voting stock can be common or preferred, but it has to be voting. And after the transaction, 80% or more of all classes of voting stock and 80% of each class of non-voting stock of the target have to be transferred. Okay, so this is a Type B. A corporation transfers voting stock to T, and then T shareholders transfer stock that provides A corporation a controlling interest in T corporation. Okay, so this 80% control requirement is applied from T stock back to A. All right, and then obviously the T shareholders own T. So after the reorganization, A corporation is owned by A shareholders and T's former shareholders, and then A corporation owns at least 80% of T. There might still be some minority shareholders that are owners of T, but they can't own more than 20%. The tax consequences of this are the target shareholders are going to recognize no gain or loss on the exchange unless their fractional shares are acquired for cash or the target redeems some of their stock. The target shareholders take a substituted basis in their acquiring corporation stock that's the same as their basis in the target stock, and the holding period is going to include the holding period of the target stock. The acquiring corporation recognizes no gain or loss when it issues its non-voting stock, when it issues its voting stock for target stock. And the acquiring corporation's basis in the target corporation stock is the same as it is in the hands of the target corporation shareholders. Here we have Allen Corporation, who plans to acquire all the stock in Taylor Corporation in a stock-for-stock exchange. Which of the following transactions will qualify as a Type B reorganization? A. All of Taylor's common stock is exchanged for $1 million of Allen voting preferred stock. This works. At least 80% of the target corporation stock is being transferred, and it's being transferred in exchange for voting stock. So A does work. B, all of Taylor's common stock is exchanged for $1 million of Allen voting common stock, and $500,000 face amount of Taylor bonds are exchanged for $500,000 face amount of Allen bonds. Both bonds are trading at their par values. Okay, so this works. This is a B reorganization because all of Taylor's stock is being exchanged for voting common stock of Allen. Also, the exchange of bonds is non-taxable because the principal amounts are the same. C, all of Taylor's stock is exchanged for $750,000 of Allen voting common stock and $250,000 of Allen's bonds. This does not qualify because of the bonds. There's debt in this transaction. D, all of Taylor's stock is exchanged for $1 million of Allen voting common stock, and Taylor shareholders end up with less than 1% of Allen stock. This qualifies. The 80% rule applies to the target, remember. So 100% of Taylor's stock, 100% of the target is exchanged solely for voting stock. That is the requirement of a B reorg. It doesn't matter how much of the parent the target's shareholders end up owning. It doesn't matter that they end up with less than 1% of Allen stock. E, 90% of Taylor stock is exchanged for $900,000 of Allen voting common stock. One shareholder who owns 10% of the Taylor stock exercises his right under state law to have his shares independently appraised and redeemed for cash by Taylor. He receives $100,000. Okay, so yes, this works because parent, Allen, who is the parent, acquires 90% of the Taylor stock. So Allen had to acquire 80, Allen acquired 90, and Allen acquired it solely for voting common stock. This shareholder who had his shares redeemed will have tax consequences based on that redemption, but it doesn't spoil the reorganization. F, assume the same facts as in Part D, except the Allen stock is contributed to Allen Sub Corporation. The Allen stock is exchanged by Allen Sub for all the Taylor stock. All right, so here it's the same thing. It's a triangular reorganization, just like we saw in a triangular type A and again in a C. This is a triangular type B, so the tax consequences are the same. The only difference is now Allen Sub is the one who is acquiring the Taylor stock. So yes, this qualifies. It's just a triangular type B. Austin Corporation exchanges $1.5 million of its voting common stock for all of Travis Corporation's single class of stock. Ingrid, who owns all the Travis stock, has a $375,000 stock basis. Immediately after the reorganization, Ingrid owes 25% of the 15,000 outstanding shares of Austin. So A, what's the amount and character of Ingrid's recognized gain or loss? So first of all, is this a type B? And it is, because Austin exchanges voting stock for all of Travis Corporation's stock. So yes, this is a type B reorganization. So Ingrid is the shareholder. She's going to have some realized gain, but it's not going to be recognized. So her realized gain is the $1.5 million of shares she received minus her basis of $375. Her recognized gain is nothing because this is a non-taxable reorganization. B, what's her basis in her Austin stock? That's going to be a transferred basis because she didn't recognize gain or loss. So she had a basis in her Travis stock of $375. So the basis in her now Austin stock is $375. C, what's Austin's basis in the Travis stock? Austin is going to take the basis Ingrid had in the Travis stock. So it's also going to be a $375,000 basis. D, what are the tax consequences for all parties if Austin subsequently liquidates Travis as part of the plan of reorganization? Okay, so thinking back, that is basically a type C reorganization. And so the IRS generally goes in and basically collapses this transaction and treats it as a type C. If that's what happens, Austin is going to recognize no gain or loss on issuing the stock. It's still going to take a carryover basis in the assets, and it's going to assume all of Travis's tax attributes. And then Travis is going to recognize no gain or loss on the asset transfer. Ingrid's recognized gain and basis are going to be the same as above. So if the two parts of the transaction, though, are treated as unrelated and they're not collapsed, the Section 332 rules are going to apply to the liquidation, but the results are about the same. It will not be taxable. And then E, as part of the reorganization, Austin exchanges $1 million of 7% bonds for $1 million of Travis 7% bonds, held equally by 10 private investors. Again, this is not going to be taxable. It's a bond for bond exchange, and there's not going to be a gain because the principal amounts are the same. They're two bond issues of equal face amounts, and they can be exchanged tax-free. There would be gain if the principal amounts differed.